Gautam Adani is the founder and chairman of an Indian conglomerate, the Adani Group, with 7 key listed companies including energy, port and logistics, mining and resources, gas, defense and aerospace, that has a net worth of $120 billion, in which it has amassed $100 billion of it in the past 3 years. Gautam Adani was listed as the third world's richest person. However, his reign would soon come to an end after a scathing Hindenburg report would cause his net worth to plummet, in which he lost $100 billion in a matter of days and equally lost his status symbol as the third richest person in the world. On January 24, 2023, Hindenburg Research, a company that specializes in forensic financial research and that is inclined to investigate companies that have accounting irregularities, bad actors in management or key service provider roles, unethical business or financial reporting practices, and undisclosed regulatory products or financial services. The Hindenburg Research published an 88-page report fraught with allegations on the Adani Group, calling it the largest con in corporate history. This is the story of how the third richest man in the world pulled off the largest con in corporate history, allegedly. I would be remiss to gloss over the fact that the Hindenburg Research at the time of the 88-page report had taken a short position in the Adani Group companies through US-traded bonds and a non-Indian trade derivative instrument. Therefore, take cognizance of the fact that the Hindenburg Research company has a financial incentive and benefits from the fall of the Adani stock prices. The Hindenburg report has allegedly accused the Adani Group of stock manipulation, the use of offshore shell companies in money laundering schemes, diamond and iron ore trading scams, inflating invoice scams, and flagrant violations of the Indian Securities Regulations (SEBI) rules. The scathing Hindenburg report alleges that the Adani Group has been involved with import-export scams through a variety of means, which include over-invoicing, illegitimate tax rebates, and misrepresentation of goods and services. In 2004 to 2005, Vinod Adani and Rajesh Adani, who are brothers of Gautam Adani, got entangled in an alleged circular trading of cut and polished diamonds by inflating the value of goods and massively boosting export turnover and benefiting from the Target Plus scheme, which was a government initiative that rewarded companies that met a minimum export threshold by giving them valuable tax credits. They benefited of this tax rebate, and it's alleged that they claimed $151 million from the government. In a 2013 ruling, the Commissioner of Customs fined Adani Enterprises $4.6 million, while Rajesh Adani was fined $185,000 and Samir Vora was fined $138,000. However, an appellate court dismissed and set aside the impugned order by the Commissioner. The Adani Enterprises were again embroiled in an iron ore scam which involved $12 billion in illegal exports of iron ore. In 2011, the Parliamentary Ombudsman of Karnataka State issued a 466-page report that the Adani Enterprises were all involved in extracting and exporting volumes of iron ore while evading royalty payments. This act was regarded as a theft of state property. In 2014, the Adani Enterprises were being investigated by the Directorate of the Revenue Intelligence for having grossly overvalued power plant equipment and creating a direct correlation to the rise in energy tariffs. As the enterprise having over-invoiced the equipment, they passed on the cost to consumers. The enterprise was also accused of siphoning off cash abroad and indulging in trade-based money laundering. This is corroborated by evidence that alleges that the siphoned funds were laundered in an offshore shell company in Mauritius that was being indirectly controlled by Vinod Adani, Gautam Adani's elder brother. The Adani Group was also embroiled in a $4.4 billion scam that involved over-invoicing Indonesian coal imports. The company artificially inflated the coal values with the sole intention of siphoning off money abroad and to increase the power tariffs, with allegations being that the inflated invoices were being routed to offshore shell corporations in the British Virgin Islands, Dubai, Singapore, and Hong Kong. 2. The second reason for the artificial inflated coal values was so as to increase the power tariffs, thereby passing the high cost to taxpayers. The Adani Group, along with other companies, have been investigated over these Indonesian coal invoice scams. Reports in the media claim that the higher coal cost prompted India's energy regulators to approve increased payments to the Adani Group and other power generators, which led to increase in costs passed off to consumers by way of hike in energy tariffs. However, the Supreme Court invoked the jurisdiction and blocked the hike in energy tariffs that was being passed on to consumers. Perhaps the most jarring revelation of the Hindenburg report is in regards to the stock backing and stock manipulation allegations. The Indian securities regulator SEBI rules require a minimum public shareholding of 25% limit, insider trading, stock manipulation, and undisclosed margin lending. The prescribed threshold of 25% public shareholding should not be controlled by promoters of the company. The Adani Group, however, in flagrant violation of this threshold, have been accused of using offshore investment funds and offshore shell corporations to obscure the identities of the ultimate beneficial owners of those purchasing stock in the Adani enterprises in order to meet the required minimum public shareholding. These offshore shell corporations and investment funds are used as vehicles to subscribe to Adani enterprise shares so that the Adani company can meet the required minimum threshold of 25% in public shareholding of the company. The Adani Group therefore secretly controls the public traded stock through its offshore entities and the use of a nominee director. All this is done to give the appearance of liquidity in meeting the public minimum threshold to help raise money while concealing the beneficial ownership. The Indian regulators SEBI rules barred an infamous stockbroker, Ketan Parekh, from markets for 14 years for rigging share prices, which included those of Adani Group. In a ruling by SEBI in May 2007, it held that the promoters of Adani Group aided and abetted Ketan Parekh in manipulating the stock market. It's alleged that 14 of Adani private companies have a planned transfer of shares and funds to 11 entities controlled by Ketan Parekh, which showed transfer of $75 million. A tribunal judge ruled that Ketan Parekh had carried out synchronized and circular trades and created fake demands and fake volume for a series of stocks, including those publicly traded by the Adani enterprises. The Adani Group is equally accused of money laundering and engineering fictitious accounts. The Adani Group has a well-oiled, intricate network of corporate structures in which offshore shell corporations funnel funds into the Adani Group listed companies with the benefit of anonymity. The capital being funneled is used to engineer the group's account, bolstering its cash flow and balance sheet to present an image to the public that the company is solvent and a good credit risk. Vinod Adani has allegedly been accused of running the nefarious network of offshore shell corporations that transact with Adani. Given the fact that the Adani Group has been accused of stock backing, stock manipulation, and engineering of fictitious accounts, it's a no-brainer that the company's solvency would be brought into question. The Hindenburg report alleges that the 7 listed Adani companies are 85% overvalued, and it also alleges that the company are highly leveraged. The report says that some of the company's current ratios are below 1, suggesting that their companies are facing liquidity issues. The companies have also been accused of using equity share pledges as collateral for loans. The share pledges have been held to be an inherently unstable source of lending collateral. This is because if the share price drops, the lender can make a collateral call, and if no more additional shares, the lender can invoke the right to force a liquidation of the shares. Following the aftermath of the Hindenburg report, the Adani Group published a 413-page report as a response to the Hindenburg report, claiming that the company are the Madoffs of the Manhattan and asserting that the allegations were a calculated attack against India. The Adani report states that the Hindenburg report is intended to create a false market in securities to enable the Hindenburg, which has short position in Adani, to book a massive financial gain through wrongful means at the cost of countless investors. The Hindenburg research rebutted their claims by aptly stating that fraud cannot be obfuscated by nationalism or a bloated response that ignores every key allegation they raised in their report. Currently, India's Supreme Court has ordered an expert committee to investigate any regulatory failures related to the country's second largest conglomerate, that is the Adani Group. It's alleged that a report by the expert committee constituted by the Supreme Court has found no conclusive evidence of stock price manipulation in the Adani Group companies. It's also alleged that the U.S. Securities and Exchange Commission is investigating the Adani Group following the revelations by the Hindenburg report.